Thank you for listening to Mailbox Money, your guided tour through safe, sacred, and speculative investing with a plan and a purpose to do more good with newfound peace of mind. Hey everybody, welcome back to another episode of Mailbox Money. I'm Jackson Wood, joined by my partner, my friend, Ryan Kruger. In today's episode, timely with the NFL playoffs, we're going to be talking about our tournament of stocks and how ultimately we use math as our guiding force of what to invest in and what to hold, and honestly, truthfully, what to sell. So a lot of the times when I'm talking with someone that's interested in investing, there'd be a client or a friend or an acquaintance, a colleague, they'll get the question of, what do you like? What do you own? What stocks? And we're going to go through in this episode our repeatable process based on math of how we end up with the stocks that we own. And one thing that I want to do is turn this upside down a little bit, because in reality, most of this process and this research is showing us what we don't want to own and what we would eliminate based on just a couple of questions that make this challenge in this tournament. The losers get kicked out of the bracket. And so we're going to get a little bit nerdy on this one, but I just wanted to, we wanted to give everybody a little bit of a glimpse into the life of managing portfolios and what goes into this. And the thing that I do want to emphasize is that this is a simple, repeatable process based off of math with no room for opinion or hope. And I think that with starting off with that at the top of mind is important context to kind of understand the rest of this episode.
And to be clear, there's a lot of ways to do this. Some probably not listening right now to this show, and we thank those subscribers who are, say all of what we're about to talk about is useless, and there's no reason to actively manage anything. Just own the entire market, own the whole index. And compared to a lot of other alternatives, that's not a bad option. It's a pretty good one compared to most of the folks that I grew up inside the belly of the beast on Wall Street, where this idea first came to pass. There's nothing wrong with that. If you don't have access to a proven, repeatable process, and whatever that is, that to me is the holy grail. It's a repeatable process, not what you think about the market and not a prediction. That track record doesn't exist over time for people doing that very successfully. We will share a quick pop of the hood, and we're going to use that S&P 500 index that is supposedly so hard to beat. We're going to use that in our bracket here in a second as an example of a stock tournament that we hold every single month in our offices as our answer to what is a repeatable, objective process. I've said many times, if there was one thing that built this firm, it's that math beats opinions. It leaves no room for any ideas, including our own. Curiosity beats conviction. And competition in general, anybody in any business line listening to this knows that competition reveals the best in your own industry. I just had an impossible time thinking that stocks would be any different than that. So we make them compete against each other. Competition in capitalism has the longest track record of any measuring stick. And I just think it's a lot of fun. So the stock market really looks like a tournament bracket to me. And as nutty as this might sound to some people, last episode, Jackson Wood was talking about birdseed, and as crazy as that was, and I'm going to quote the CEO 1 week later. He must have listened to Mailbox Money and your comments, Jackson, because he said, and I quote, "Work hard, have fun, and make money. That is our business plan."
I love it.
After reporting the 31st consecutive year of operating revenue growth. So I'm lucky that fun is a big part of what I like to do, but I would say fun is an underrated part of a business plan. I can't wait to come find out every month what these tournaments are going to reveal. I don't want this to be about what we like or think's going to happen. I grew up, I saw how poorly that worked on Wall Street. And let's just the psychology of it. If you do fundamental research, and there are folks that can do that and do it really well, and you spend 3 years of your life listening to management, talking to customers, knowing the industry, researching the business, making your investment, what is the likelihood that you're going to want to abandon all of that blood, sweat, and tears and work? And you have some real sunk emotional costs in there too.
Yeah.
If something were to change in the business. And dare I say, with the bias of having fallen in love with that idea, what are the chances that you're going to notice that change, let alone have a self-discipline to act on it? So we have, the stock market is set up, and the entire field of contestants and tournament tickers, the crowds are going to move prices. And that's another thing that really works in our favor, because crowds are trained, whether it be in basketball or stocks, they love dominance. And when there is the subtlest of improvement underneath on some team that nobody's ever heard of before, it's often completely ignored. When it is revealed, it's often undervalued for a long period of time. So a simple willingness to pivot and look for that change. And if I had one lesson to share with anybody, however you want to do this, and looking for that dominance, the translation in the stock market, I think the most overused term is wide moats, especially in dividend investors that think if you just find the biggest wide moat, the greatest tradition of success, you're going to have a difficult time not succeeding. And I notice moats, what we want to pay attention to is the direction, not the size, because any moat, any tradition, any dominance, they can spring a leak. So a formerly unquestioned darling that's probably overcrowded and overvalued can spring a leak, and it can change. So that's one of the things we're looking for in these tournaments every single month that we wouldn't know unless we are able to trust the math. And very, very small advantages, small moats, creek maybe down here that dry up sometimes, a little bitty creek can start to widen a little bit. That to me is more interesting than the obvious wide moat. So if the principle that drives all this is that we are curious of everything with no preconceived notions, and we're convinced of nothing, that's why I'm so excited to see what these stock market tournaments are going to push out to us every single month, which then we dig in after the objective data does all the heavy lifting.
I love that concept. And I know, like, every time I think of this size of the moat versus direction of the moat, the concept, and you had a chart about this, and we're going to bring that up a little bit later on in the episode. Just because a company is paying a dividend and has a track record doesn't mean that that's going in the right direction, or that the company is something we believe is growing quarter over quarter. And so I want to emphasize that as well. As you build portfolios, that's just the starting point. And then it continues quarter over quarter, month over month, as things inside of the business change. I told a client just this morning, if a company is able to grow their dividend quarter over quarter, and it's coming from a small portion of their free cash flow, what does that mean for the business? What are they having to do the month before, 2 months before, or a year before in order to pay an increased dividend over time? And if you think about that as a stakeholder from that perspective, that gets me excited, and I think it's motivating. And then we could spend hours talking about how that translates to your Freedom Day, and how that translates to income in retirement and growing income, and how it fits all these pieces together. But I just kind of wanted to bring that up as more motivation, I suppose, or feel good moment about what we own and also what we don't own. I think that is an under-discussed part of this as well.
Well, I think, we shared some data that was shocking on one of the unquestioned bluest of the blue chip lists of, they're known as dividend aristocrats. And again, like the S&P, you could do a lot worse than just buying companies that are raising their dividend every single year. And there's a lot of investors and forums, and whether it be do-it-yourselfers or professionally managed funds and ETFs that just simply buy that list. And again, you could do a lot worse. But if you just pop the hood a little bit, and we shared this past week that 2/3 of the dividend aristocrats, the best of the best, raised their dividend last year lower than the inflation rate. 1/3 was less than half of the inflation rate. And 15 of the best raised their dividend less than 2%. I share that one simple example because some of what nobody's ever going to question, and some of those traditions, the dominance, the wide moats, they actually offer more red flags potentially than reasons to dig in your heels and assume nothing will ever change. Everything changes all of the time. So the simple math, and the reason I love relying on this, not having to figure out the entire market, is, and why we rescore every stock every month, is when the inputs change, so will the outputs eventually. And what do I mean by that? If a business, especially a long tradition business, they might not change in a month. The whole business may not change in a month. And the fundamental analysts say, find good businesses and you're going to be all right. Just even Charlie Munger and Warren Buffett have kind of helped people. They got really lucky and invested in the right time in a few of the good businesses. So it's easy for them to say, then you can just sit on your butt and do nothing. The same business, though, because this is an auction, the stock market, with wild emotions and bids, is priced differently at the end of the month and the beginning. So while the business may not have changed, your odds of success as an investor could be wildly different based on your starting point. And if you have an efficient vehicle, and it took us a long time to figure out, and then we just decided to build one at our own expense, an ETF, for example, you can trade very efficiently and have sell disciplines and new buy stops without suffering tax consequences. So actively managing this not only can work, but it's more efficient than ever. So game on. If there is a change in 1 month or 1 week or 1 year that requires a sell discipline or a buy discipline to kick in, I absolutely believe, and I know, and we've proven, that you can change your odds of success. So I would just keep that in mind, however you decide to measure stocks. And we'll share with you one example of how we score them here. You'd have to at least agree with that when the inputs change, so should the outputs. And none of our predictions are mixed in. So with that.
Can I say something real quick?
Good, because I'm gonna shock some folks with some bluest of the blue chips, and we're gonna line up a bracket here, and we are going to bust some brackets. And yeah, I'm getting excited. It's basketball season too, brother. We came off our little team last night came off a big win. Nobody expected us to do much. We're not very talented. This big old dominant team, and every once in a while, and I told my little 10-year-olds that when you get a little momentum and things change and start to go in your direction, it does tend to feed on itself. So momentum's a real thing, and change in the stock market's a real thing. And when you notice a little bit of change that starts to accelerate, you have set yourself up for the most shocking upside. Am I talking about basketball or stocks? Yes.
That's right. Think of UCLA in the 80s. I took a sports psychology class on momentum in college, and that was the top example we could come up with. When I think of aristocrats, a lot of people just believe that's the ultimate strategy. And maybe I'm going to make some.
Jackson, I apologize. Let's define aristocrats real quick. So it's companies, when I said bluest of the blue chips, they've raised their dividend consecutively for at least 25 years.
Yeah, that's right. And plug your ears if you're from Cincinnati here. But what I want to kind of explain about the aristocrats is there are certain companies that may meet the qualification of having raised their dividend for 25 consecutive years, or even longer in a lot of cases, that you would never, once you pop the hood, want to hold in your portfolio currently if the direction of the momentum from the business perspective or whatever isn't improving. And I'm thinking of the Bengals, of how in the world they're still in the playoffs. You look at the lineup, and it's kind of a joke, right? But there are certain teams in a tournament that you just would not bet on. But for some reason, they're continuing through. And so I just kind of wanted to set that up and paint the picture of the aristocrats, and how just because they make it through one screen or one filter doesn't mean it's something, there aren't red flags in others. And our approach to the tournament is to have different requirements that each company has to go through. And you're going to walk us through an example of taking the S&P 500 through giving 4 questions or 4 tests, and how many stocks that whittles down to. And it's pretty remarkable. I had to ask you before we recorded if I'm understanding the final number right. And I was. It's shocking.
Well, and we're going to always keep these to quick hitters, just if we provoke an eyebrow raised and a curiosity, and gets anybody to a better place, wherever that is, mission accomplished. So we happen to use dozens of different metrics to score stocks every single month. I wanted to make this short, simple, to prove a very quick hitter point that hopefully anybody can at least question an unmanaged index or a belief that the market always works out and that there's anything passive about investing. Because, by the way, little secret, and we shared this, and it's in this year's picture book that's getting sent out this weekend, by the way, if you are interested, that one trade in the passive index, which, by the way, is managed by an index committee, it's not passive at all. There's individual trades within the index. One trade last year cost the Dow 1,500 points by playing to the crowd's emotions, even at an index committee level. So let's agree one thing real quick. There is no such thing as passive.
Yeah.
If we're all active and our families are relying on us to be active, and whatever that means, what's the process? What's the selection? And does it work on a repeatable basis? So when somebody asks me, what stock do you like, or what do you think about the market? I just answer, I don't know. Let's go look. And based on the new scores, I'm not in love with any of those companies. I'm in love with math because it keeps my opinions out of it. If we ask the market the same question every month, the answers change because all of the data is moving. So here are 4 questions, only 4. I whittled it down. You turn the screws on me here to think. I was excited when you said let's take a peek at the tournament brackets that you've built and that you work on and you tweak and you try to improve, because nothing should be sacred, including our own system, if there's any way to improve it. And I said, wow, all right, we use dozens of different ways to measure this. How are we going to do this in 25, 30 minutes? Well, how about if we put the best companies in the world and we only ask 4 questions, how many would we be left with? And here are the 4 questions that most basically summarize all the different brackets that we use. So if we had to categorize them into a final 4, so to speak, they would be: 1, operating business advantage; 2, dividend quality and growth; 3, the direction of that advantage and growth; and then 4, valuation for that stakeholder, the price being asked by the market. So here we go.
starting with 500.
Are you going to cue the one shining moment? My favorite. I do play music when I'm hosting because I'm usually alone with these tournaments. It's just me and the numbers. And with you, we quickly shut. So if you want to play one shining moment, we're going to get this bracket busted all over the place. So we started in this case. We happen to use all stocks, but let's just attack the best of the best to shock people of how many stocks we would not want to be interested in, or at the very least would have a red flag to examine and be really careful with. So of the S&P 500, first question, operating business advantage. Just using two measurements, so operating revenue, so sales growth, but operating recurring revenue, along with free cash flow growth over the past 3 years to smooth out any 1 year, especially in the last couple of pandemics, $1 or more of growth of operating revenue and free cash flow eliminates half of the field. Second question, dividend quality and growth. Two of the ways we measure that, real simple. Did they raise their dividend over the last 3 years? And is it being paid, the quality part, from free cash flow? And a simple measuring stick is 50% payout ratio of free cash flow, not earnings, or less, leaving dry powder for the business. Dividend growth and the quality of that dividend eliminates half of that field. Third question. This is where we have to roll up our sleeves, and it can't be done by a simple stock screen. A lot of folks listening to this can do some of this and their own with models now that are more robust than some Bloombergs and Wall Street analysts had when I started in this business 26 years ago. We like to dig and do a little heavy lifting and math on our own, where we take that business advantage from number one and the dividend, so the growth of each, but not just look at the growth rate. This is where the Georgetowns of the world get upset by Villanova, the dominant teams, the wide moat, not just the high growth rate, not just, oh, did you see their profit margin? Yeah, everybody sees their profit margin. And guess what? So does competition. If you have a big fat profit margin, it attracts competition at best. At worst, it attracts a crowd of investors that overpay for that obvious advantage. I'd rather look for a margin that's expanding, that's smaller than a large margin that's leaking. So we'll measure the direction of those growth rates, the operating business and the dividend. Is it accelerating? And we are now down to 25 out of 500 of the bluest of the blue chips by asking those three questions with no big bar or threshold. $1 or more, 1 or more percent. that was the screen, period. Then if we just simply ask, and again, we didn't go into this, we're growth guys or we're value guys. We haven't even measured prices or valuation yet, right? We're just looking at the operating business. Do they pay stakeholders? And the direction of each. Then we ask, is the market, based on all sorts of crowded emotions and psychology, sitting in the stands rooting for certain teams, is the market pricing those businesses above or below an average valuation? Before we start any of our work, just the simplest threshold, just average of the entire market. In this tournament, we used enterprise value divided by EBITDA. There's a lot of different valuation methods we can use, price to sales, price to free cash flow. We like to use the ones that can't be manufactured as much. You'll hear a lot of free cash flow and a lot of our columns using the math, keeping management out. Math doesn't lie. People do. That 25 is whittled down to a sweet 16. And no, I did not make that up because I'm a basketball junkie. 4 questions, 500 of the best stocks in the world get whittled down to 16 as of this morning. That same tournament, same questions will be a different answer at the end of the month. That's why we rescore them across dozens of different metrics. No name on the front of any jersey in a basketball arena or the stock market should be sacred. No lead is safe. Who is improving the most? And if we can find those perhaps being ignored, then we have an unusual opportunity in the stock market to establish a position to get paid and increasing payments of mailbox money over a significant amount of time.
Yeah, I absolutely love that. And if you think about how we call this your sacred money, and the reason we call it sacred is because not only are you working hard for it and is it protecting you now, you're going to be relying on this money that you're saving and investing to pay you in the future and to continue paying in the future. And I just love with that mentality thinking about what do I want to put my money into? If you asked someone what type of business, they would list things that are similar to the screens. And if we need that money to continue paying us in the future every year, once we've quit working, once we're at our freedom day, it's worth it to pop the hood and make sure you know what you own and why you own it, what you don't own, why you don't own it.
And that is just one tournament and one starting point. Let's jump ahead. And if anybody's listening to this that wants to do this on their own, we're certainly happy to help or offer any suggestions for other resources or how we operate. But then it comes down to roster construction. So those just happen to be the biggest of the big companies. And with that one tournament, some folks would be shocked that Sweet 16 actually includes companies from all sectors. Where folks get in trouble, including dividend guys, is they'll end up overly concentrated in certain areas, no different than I'm a tech guy. The dividend guys can be just as concentrated as risk as the high growth tech guys in Silicon Valley. I want to avoid either concentrated risk. I want a balanced roster. Right. I need, and the reason I picked up my center last night after his 5th rebound, I need a big guy and a ball handler.
That's right.
I need a shooter and a lunch pail guy that'll get in somebody's grill and play some defense. I believe in no matter what those answers are and what your process is, it has to be balanced at all times. So my head eventually finally hits the pillow. I never go out leaning to one side or the other in the market. We have a lot of data. Our work suggests that you don't have to own hundreds and thousands of companies to do that. Our rosters are no more than 50 names, and we are balanced across all sectors. And we didn't even talk today about smaller and middle-sized companies that offer even more compelling values when they're on their way improvement, that sweet spot becoming a big successful company. I just wanted to use this example because it's the one most people know and the one that a couple $1 trillion are invested in without asking any questions at all. I like asking questions and I like whittling down. And this has a lot more to do with what we don't own in order to get down to 50 than what we do. And none of it should have anything to do with what I or anybody listening to this believes or predicts. That doesn't have a very good track record. Math and competition has a really, really good track record in capitalism, and I'm there for it.
That's a mic drop. With that, I'm going to leave it there. If anybody has any questions, would like to talk with us or schedule a meeting with our team, you can reach out to us, team@freedomdaysolutions.com. You can check out our website, linked in the show notes here. And with that and all that math, we will see everybody next week.
This show is brought to you by Freedom Day Solutions, LLC, a registered investment advisory firm advising individuals and families nationwide. Performance is not guaranteed, and past results are not necessarily indicative of future performance. To learn more, visit freedomdaysolutions.com. This show contains general information that is not suitable for everyone and was shared for informational purposes only. Any forward-looking statement or opinion expressed is subject to change without notice. Nothing contained herein constitutes investment, legal, tax, or other advice, nor is it to be relied on in making investment or other decisions. Clients of Freedom Day Solutions may hold positions in the securities discussed.